side of things. Right? Then we wait for the axis signal. Okay, now yes, not the ideal axis signal, not the picture perfect axis signal, but that's the nuance. Okay, that's the nuance that we want to minimize as best possible. Okay, remember what I said to you in part 3. Yes, there is always going to be an element of discretion within what is access, what isn't access. Okay, and again, you can gauge on that. You want to be obviously as close to a rules-based approach as possible, but equally you also want to make sure that you've got some sort of flexibility, because that's the power in being a discretionary trader. Okay, so we can see the market's come up to us now. Right? It's traded the 14s, and we're just going to watch this. I just want to, obviously, because the simulator is not a real fill. Okay, and we filled. Now straight away, I want to take you through the psychology of this entry point. Is there any need for me as a trader to consider risk now? Okay, the simple answer is no. Okay, there is no need. And straight away, look what pops up. Okay, there's our cue card. It tells us our strategy. It tells us the market we take this trade strategy on. It tells us the axis type we're looking for. Okay, our SQN. Okay, this is our probability of our trade opportunity is 43%. Okay, so this is your hit rate. Okay, this is how often this trade is profitable, 43% of the time. Okay, so it's got a relatively good hit rate number. Okay, and remember what I said to you. If we were to strip out, if we were to take all the preemptive times we do this trade, you'll see that SQN number will come probably all the way down to 15%. Okay, there tends to be a lot of false breakouts on this trade strategy. Okay, it does tend to be a lot of false signaling in this trade strategy, which is why we lean on the axis. It's why the axis is so powerful. Okay, now what we said there is entry is on confirmed axis, which we've done. Okay, our stop is at the axis extreme. Okay, and we've put our stop on the 19s because that is the axis extreme. And we've said we want to be cautious in brackets there. We've put a star. We want to be cautious because of the short-term positioning. In other words, right now, because of the break of this trend line, because of the break of this consolidated range, there tends to be quite a bit of shorts positioned into the market. Okay, we can also see that, by the way, if I was to bring this up for you again, we can see those shorts positioned with this cumulative delta. Okay, that's the white bars below. So there is quite a bit of accumulation of shorts on the day already. So we're aware of those shorts, because if they get unwound, if they start to take profit, it means we're going to get washed out of this trade as well. Okay, so we don't want to be last out. There's an expression: if you're not first out, you're last out. Okay, so we don't want to wait for them to get out and the market to be 10, 15, 20 pips higher, right? Because that means that we're just going to have to pay up a lot more in terms of a stop. Okay, and then our target, as mentioned, is the range of the consolidation zone. Okay, so we're going to be looking at the range of the consolidation zone, and we're going to take 80% of that. As mentioned, that is 137.30. Okay, now in terms of the execution notes, as I've mentioned, if there's early access, be aggressive. Okay, 23% of the time you do get early access to these. So the other three quarters of the time you don't get. Okay, market positioning prior on the daily, that was the daily chart I showed you. Is there positioning? Okay, is there a natural trend in the market? If there is, what's the path of least resistance? Okay, at the moment we said there is no natural positioning. The market's actually quite flat in terms of its positioning. Now, once continuation move, stop to break even. In other words, once this takes out this low, what I'm going to do is I'm going to move the stop down to our break-even point. Why? Because the market's showing us a bit of momentum. It's showing us fresh shorts coming into the market. It's showing us continuation. Okay, at that point, we can tighten up the stop. We've then said, don't add on a move lower, get full size on early. In other words, one of the mistakes I used to make was I used to, I would maybe build a position and start to sell on the way down. The reality is when you do that, you're making a massive assumption, which is that there will be momentum and continuation in the market. Okay, so for me, add the position on full straight away. Put the position on, take the risk early because you'll get the reward for it. If you take the risk lower down, you're just taking on a bigger risk profile. Okay, and then the key variables to watch out for: high number of false breakouts, as mentioned. The real risk reward. Okay, we talk a lot about real risk reward in lesson 21, I think it was, 22. Okay, we're not looking at hypothetical risk reward, we're looking at real risk reward. In other words, these are the times that we actually do make a profit on the trade. Obviously it's greater than 4-1. Okay, and we notice that there are two different trade opportunities. One is the continuation and one is the reversal. Okay, so that is now our trade. You can see that's our cue card. The trade has actually just been stopped out, so we can see the trade got stopped out of the 19. And we can see now that we're going to go and commit this trade. So we've taken a loss on this trade. That's fine. Okay, not the end of the world. These things happen. What we want to do now is we want to go and commit that trade. Okay, and we want to complete the trade. So yes, we know how to do this. Okay, we take our loss. Now note, there's no panic here. There's no emotion. There's no frustration. There's no nothing. There doesn't need to be. Okay, it's just simply part of the process. Right, I actually just want to check that we, okay, it did trade the 19s. So this is the most important aspect of this, guys, and I cannot stress this enough. When we're trading well, when we're executing according to a plan, we don't have to worry about losing. We don't have to worry about, how much I should risk, how much am I up or down on the day. None of that's relevant. Okay, our P&L on the day is completely irrelevant at this point. Okay, why? Well, because at the end of the day, everything's taken care of. We've pre-planned for both winning and losing. Right, now, what we can see is we can see that euro starting to offer again. Okay, and we can see the pound holding up, and that's that proxy I was telling you about. We can see how the euro is so weak relative to the pound. Okay, so what we're going to do, we're not going to give up. This trade's not done yet. Okay, we're going to keep watching it now. I'm going to go on a little bit quiet now, and we're going to keep watching it. Maybe we get another access to the downside. Okay, we re-engage. Right, just because we've lost on the first opportunity doesn't mean the trade opportunity is over. Okay, equally as mentioned, if we get above our little high point here, above our 138.20, and we close above there, we're actually going to cut and reverse this trade long and start to trade back towards the upside. Okay, so we're taking on two parts of the opportunity, making sure that we are aware of both sides of the tradable opportunity. Okay, so what we can see here now, which is quite interesting, is we've got this euro dollar starting to tick back up. Okay, that's our proxy market. And as we said, once we get above our access entry, which is the 38.19s, we actually want to start then becoming a buyer of the market, looking for a move to the upside. Okay, so we're now going to enter on the long side of this. We're going to play for a run out of those shorts. So anyone that was selling for the breakdown, we're now going to enter this trade and play from the long side. Now straight away you can see we've entered without risk. Okay, and this is important. We've got to be pre-planning these things, so we've got to put the risk on. Make sure we're utilizing the same. We're using the same approach. So again, this time our stop is going to be below our trend line point, which is sitting down at 10s. So we've got an 11 tick stop. Okay, and we're going to add that in. And we're now going to see what the market does. Okay, notice straight away we're getting exposure warning here. It's telling us that we are a little bit underexposed. We're 4 lots underexposed. So let's bring our exposure back up. Okay, we're going to try and get it at the same price and make sure that we get the full size off. Okay, we're also going to go and put our stop on, and again we've got a 10 tick stop. Okay, so note our stop is in. Okay, and one of the things I want to show you now is notice how in terms of the process, okay, because we didn't have our trade prepped, because we didn't have our trade logged, we didn't know what the lots required were. Okay, now because we've had to go momentarily, add the trade and maybe take an extra minute or so, we now run the risk of one being underexposed because we've only got 10 lots on, but also now we run the risk of maybe chasing these other 4 lots into the market. Okay, so you can see how just having a poor process is going to end up potentially costing us either under risking, okay, or going up to the market. Okay, so now I'm going to have to pay up on these 2 ticks, and just a basic math sum, 2 ticks on a 4 lot, okay, is going to cost me an extra 20 pounds, okay, an extra $25. So it's unnecessary. That's the point. It's an unnecessary pay up because I didn't follow the process. Okay, so we're now fully exposed. We can see that our lots are correctly exposed. We've allocated 962.50 cents to this trade. And notice we've still got good available risk, and now we're going to sit on it. Okay, so now we sit on the other side of this trade. We watch this trade from the other perspective. In terms of target, okay, what we're doing is we're targeting now the upside of the trend channel. Okay, so because we failed, We fell to the downside. Okay, we're now going to be placing our target towards the upside of this trend channel. Okay, so we're going to be looking around that 56 area. So we can see we currently entered a 22. 56 is a 34 tick winner, and we're risking 12 ticks for 34 ticks. Okay, so again, almost 3 to 1. Right now, the reason I like to throw out these, real risk reward ideas is because you can see that with the access methodology, because we're managing our risk so tightly, okay, it means two things. And hopefully you've recognized this from part 3 of the course, but it means, one, that we are potentially going to get stopped out of quite a few trades. Okay, we're going to get stopped out of quite a few trade ideas. But the reality is our stops are always going to be very managed. They're going to be very contained, and they're not going to be very big. Okay, but the moment we get that one winner, think about the power of this. Okay, we're currently using the equal weight system here. Now, in theory, because of the system we've chosen, we do an average of 5 trades a day, which means that, let's say we get our first 3 trades wrong. Because the trade strategies we're adopting have all got really good risk-reward ratios, we can afford to get the first 3 wrong and get that 4th one right, and we're back to break even again. Okay, now if we've got hit rates of 40%, 50%, sometimes even maybe up to 55%, it means that because of the risk management approach, the dual risk management approach we're taking, which is, one, we're utilizing the access methodology, which manages a specific risk approach, and 2, we're using a mathematical formula to allocating our capital. Think of how powerful that becomes in the long run. Right? That's what this entire course is about, is to show you the power behind a process. It's not about being wrong or being right. I couldn't care less whether I'm wrong or right. What I care about is a very strong process that will get me the desired results in the long run. Okay, that's the importance of it. Now, what I want to show you is, notice how this euro is ticking up. Okay, so what we can see, and this is something I quite like about TT, we can see the last time since we spacebarred, we can see that the euro has gone up another 5 pips, and the pound has actually not moved much. Okay, so what I'm expecting to see in a moment is I'm actually expecting to see a little bit of a flurry to the upside in the pound. Why? Because remember, we said the euro is the weaker of the two. Okay, so we always want to buy the strong market and sell the weak market. In other words, the pound has been the strong market today, therefore it should lead to the upside. And given the euro dollar is currently, bidding off of that low, seeing a bit of buying, we should hopefully start to see this trade work in our favor. Okay, now with regards to trailing stop, again, I don't like the idea of trailing stops. I've never liked the idea of trailing stops because it just brings in another decision. Okay, it brings in another, idea that I have to think of another creative way. Okay, if we got a process of one time framing, this is the only time you'll see me, rotate a stop. If we started to see some one-time framing and we saw 15-minute candle after 15-minute candle with higher lows and higher highs, at that point, yes, okay, trail the stop, of course, right? Because you're getting price action, you're getting objective price action that tells us that we can now, do this thing called a trailing stop. Okay, but it's objective, which means that we can apply it every single time. Not, I went on sides quickly, or, you have to be objective, because the more objective you are, you can repeat those patterns in the long run. Okay, so if we were to get some one-time framing, and we'll see this obviously play out over the next couple of minutes and hours, but if we see some one-time framing, we can then move that stop up, okay? And that's what we're going to do here now. We're going to go up, we're going to place our target at 56s, and literally just sit this through. Okay, that's the trade. The trade's on. There's nothing more for us to do now. Now we just observe. Okay, we observe the facts. Okay, we observe what other markets are doing. We observe what the dollar index is doing. Okay, that's our objective now, is to make sure that we're just observing the facts as they're coming into the market. We're not questioning ourselves. We're not doubting ourselves. We're not doubting the trade strategy. We're not thinking at this point. All we focused on is the objective facts coming into the market. Right? We're not emotional. We don't need to be emotional. Right? Everything is done. Everything is in place for us to execute our methodology ultimately. Okay, so at this point now, we can see that we've had a candle close above our entry candle. And this is what we talk about one time framing. Okay, we can see higher low, higher low, higher low, higher low, and at the minute, higher low. So this process of higher lows as well as 1, 2, 3, and 4 higher highs is what we call one time framing. Now, it's important to note that you've got to have 3 or more candles to constitute one time framing. So once we've had 3 or more candles of one time framing, at that point and only at that point can we bring our stop up. Okay? So we're going to bring our stop up now, and we're going to bring it up to the base of the previous candle, which is around 18. Okay, so we're going to bring it up just below the base of this candle. Make sure that we're not unnecessarily stopping ourselves out. Okay. Now at this point, this is quite a powerful position to be in, because the reality is we can sidestep the loss part of a trade opportunity and potentially expose ourselves to the upside opportunity. So it's very, very important to just recognize what a powerful position we are in now, and make sure that when you're in these kinds of positions, recognize it, but also recognize this is the only instance in which we use one time framing to shift a stop. Okay, I will never ever use trailing stops in any other situation. Okay, the reason is just very simple. I've never believed in complicating the decision-making process. The moment you invite into the decision-making process trailing stop, all sorts of other questions begin to arise, and most importantly, you start to skew your entire process. Okay, everything changes. Your risk-reward metrics change, your approach changes, your emotion changes, the stop you take changes, the profit you take changes. Everything suddenly changes. And what for? And that's the important question to ask. I always have a lot of people ask me about the trailing stop, and my stock standard response is, well, what for? What are you trying to achieve with a trailing stop? The reality is most traders' response is the same. They want to reduce risk, okay, which is fair enough. But what most people don't realize is that reducing risk is not necessarily just reducing the amount of loss you take when your stop is triggered. Reducing risk is also ensuring that you allow yourself enough, sort of breathing room to allow a trade to play out. Okay, and that's an important differentiation, because people want to just tighten the stop to minimize the potential loss, but what they don't recognize is they actually also reduce their probability of success. And that's important. That's why we avoid trailing stops. That's why you'll never hear a single Axia trader ever talking about trailing stops. It's just not something that you do in day trading. It's not something you need to be doing in day trading. Warranted if you're a swing trader and you're a long-term trader, fine, I can understand. You want to make sure you don't have any of the so-called popcorn trades. Okay, popcorn trades are the ones that, they pop and they come all the way back down. So they give you the move, they go sort of 3/4 of the way to where you think they do, and then they come all the way back down. So yes, we want to avoid watching profits come all the way back, of course. But we do it with an objective methodology. And the only time we do it is when we've got one time framing, and when we've got one time framing, we simply trail our stop. Okay, so what we're going to do is we're going to continue trailing this now. Every time we get a new candle close, we're just going to shift this higher and higher up. We're just going to trail it in behind and make sure that we don't have this come back, all the way back to our starting price. Okay, so objectively, what are the facts we're looking at? Well, we can see that on the euro dollar, that's continuing to tick up. We're now 5 pips higher, so continuing to rotate higher. As we said, that's the weak market, pound's the strong market. And we can see our pound is just steadily ticking higher. Okay, again, we're looking to target anywhere around somewhere that 48 to sort of 50, 51, 52, anywhere around there. Okay, so anything that gets us there, for example, if we saw a bit of volatility now, okay, remember I told you the positioning on the day. Let's get that chart back up whilst we are. Okay, so what we can see the cumulative delta is nice and negative on the day. Okay, so if we get any kind of a volatile candle now to the upside, or a big spike in the delta, or a big spike in the volume, that's going to be our signaling to get out. Why? Because that's that unwind of that little bit of an aggressive short position. Okay, so we're going to take profits when those shorts finally stop out of their trade. Okay, but until then, we stick with it. We stay with the trade. The trade strategy hasn't changed. We're just going to watch it slowly but surely play out and allow ourselves full access to the opportunity. So again, now we can see that another one-time framing candle, another higher low being made. But very, very interestingly, notice what the euro is starting to do. Okay, remember our weak market? Okay, the euro is what kind of gave us this bid up in the pound. We can start to see now that the euro is steadily starting to offer. Okay, so we're going to be very, very vigilant here. We're not going to escape the trade. We're not going to panic the trade. For a start, we're going to move our stop a little bit higher. Okay, so at this point, we're going to move our stop all the way up to 26s. Okay, and what we're going to do now is we're actually going to start to look to take some profit if we start to break down below this previous low. Okay, so we don't want to get out of the entire trade. Why? Because nothing's changed. Okay, the strategy's not changed. Nothing's changed in the strategy. We still have one-time framing, which shows us strength. But as mentioned, we were starting to see the euro offer a little bit. Okay, obviously it's now regained its poise. It started to bid up a little bit. Okay, and straight away, the moment that euro went bid, notice how the pound just ticked up. Okay, nice easy bid in the pound the moment we saw that euro dollar tick up. So what we want now in an ideal situation, this is what I mean by by seeing around corners. What we would ideally love is we'd ideally love to see this euro get back above, 62s, 63s, because that should just give us that final little bid up in the pound, get towards that target of 50s. I think it is. Sorry, I think we're a little bit higher. Okay, we want to get to that target around the 50s so we can get out of this trade, lock it in, and move on to the next opportunity. Okay. So we can see again, euro starting to tick up a little bit. We can see our target is somewhere again around that trend line, anywhere between 48s and 54s. If we get a little flush to a flurry to the upside, that's going to be our signaling to get out, lock in the profits and move on to the next opportunity. Okay, so we can see that euro, and again, I'm just talking through the facts, talking through what we're seeing. We can see the euro a little bit, it's pretty much bounced off of the low of the day, 13, 14 pips. And the result is it's kind of given, the pound that turnaround. Okay, so we've done from the low to current price in the euro, we've done 13 pips. In the pound, we've gone from a new low of the day, which was 04s, all the way up to 40s. Okay, so 14 pips versus 35, 36 pips. Okay, so we can really see that strength coming into the pound. And again, yes, we had this strategy. Yes, we had the risk management in place. Yes, we had all the processes taken care of, controlling the controllables. But the only reason we're capable of interpreting something like the euro being strong and leading, the only way we can be capable of recognizing these things is if we allowed to be wholly objective. Okay? It's when we have this clear train of thought that we can view and observe things for what they are. Right? The only reason I can talk you through things like this is because I'm not having to think about risk. I don't have to think about the strategy. I don't have to think about the trailing style. I don't have to think about any of these things because they're all pre-thought. They're thought of pre-risk. Okay, when we're in the risk, we're paying attention to the facts. And the facts are the euro's been the weak one on the day. The pound's been the strong one. Okay, so we can see that euro's now back to that 118.60, starting to bid up a little bit. Let's see what happens now if that euro suddenly pops up to 2s and 3s. Let's see how that pound responds. Okay, that should give us that final little 10 pip, of opportunity we're trying to lock in and finish this trade opportunity. Okay, so we can see, notice the euro trading 63 and a half. Okay, watch the reaction function in this pound. Let's see how quickly this pound suddenly ticks up. And bid. Straight onto the 3s. Okay, straight onto the 3s. We can see a little bit of a reload on the 2s. Okay, euro back up to the 4s. Straight away someone's lifting the 4s. Right, this should now, and again, as I'm talking you through this, I'm very aware of we're getting close to that 48 to 53, 54. That's the target for this trade. That's where we want to take profits. Okay, so any kind of a flurry to the upside, and that's it. The trade's finished. Right? So we can see euro trading 4.5, 5. Nice bid that's come into the euro. Again, quite surprised that we haven't seen that little bit of a harder bid in the pound. Taking its time a little bit, but okay, giving me confidence. This is the point. It's giving me confidence that, we're good. We're good in this trade. The opportunity is playing out quite nicely. And for all intents and purposes, another couple of minutes and this trade should be finished. Okay, so we're just watching this price action very closely. Now we ticked up to the 8s. That's where we thought, the market might stop, somewhere around those 48s to 50s. We're just watching this very closely, just trying to see if there's any reason, price action wise, for us to just take profits. Okay, we can still see that euro bidding, so we're not going to just rush out straight away, not going to panic just yet. Okay, we can see a little bit of a reload coming into the pound, so we can see, even though someone's buying it, okay, we can see nice reloading on the 6s. Okay, but equally, what we can see is someone's reloading the offer as well. All right, for that reason, we're now going to start to look to take profit on this. Okay, get out of this trade, lock it in. Market has come up to our objective, and we're now going to look to take in our profits. Okay, notice the hard reload on the offers there. Right, market went bid and straight away 64 offered. We can see a seller stepped in. Yeah, now's the time for us to take profit. And again, this is why you always, as you get close to the target, you really, really want to start watching and observing, making sure you're not giving away ticks unnecessarily. Okay, we can also start to see, notice how the euro's gone a little bit offered. So again, we're just focusing on the price action. Okay, bid up should get us out now. Right, notice straight away reloaded 64. So we can see someone is starting to sell that euro. Right, we should start to see a little bit of an offer in that euro, and that's why we don't really want to hang around too much longer in this pound. We've taken our 40 pip winner here, we've seen the market bounce 40 pips off the low of the day. Note the range for today is only 60 pips, so we've done almost the entire day's range in the last hour of trading. Okay, so we're watching. Notice how market is just reloading in front of us, so we're going to shift that offer down. Okay, we're not going to hang around too much, not going to waste profits here. We can very clearly see someone is trying to sell the market. So we just want to make sure that we lock in those profits as best possible. Okay, again, notice how the euro's just gone offered there. So we can see really someone is stepping into the market here, buying a little bit of dollars again. We're starting to see that euro just rotate a bit lower. And that is our cue now to take our profits. Okay, and I know one of the temptations, I know this as a trader, the temptation so often is, to panic on the way down and panic profit take. But the reality is you've just got to be patient, okay? More importantly, now we get to the point where we go and observe. Okay, now we get to the point where we go and view this trade, debrief on this trade, look at what we did well, what didn't we do well, what can we improve on. Okay, so let's finish up, let's wrap up. We clear our order book, nothing left on the ladder. Okay, trade is now complete. We're going to come and we're going to accept and commit our trade. We can see that we had a very, very nice winner on the trade, almost a $2,000 winner. Okay, so our real risk reward, remember we were risking 10 ticks. Okay, on 14 lots, our real risk reward was somewhere around, our real potential loss was, I think, 900 or 800. Okay, so we're looking at around 2.5 risk reward. Okay, real risk reward. That's what we really realized. Now, you can see very clearly there how risk reward is such a misleading metric, because notice how I got out at 44, 45. Okay, the target was 48s to 50s. So there's almost a, call it 5 pip difference there. Now imagine if I saved this risk reward of this trade, of all my trades, regardless of where I was actually physically taking profit or not. Can you see how, sort of hypothetical risk reward is so misleading? Okay, because how do we know we would have actually got out at that price? Right? Like I said, if you're using a fully automated system, fine, fair enough. Risk reward is a good metric then, because you're basing it on all observations and you're not having any discretion with regards to entry and exit. But the reality is, for us as traders, for me it makes sense to look at real risk reward and real risk reward only, because that's what you're really recognizing as your reward. That's where you're really getting out of trades, not where you hypothetically would have got out of the trade. Okay, so we're going to save that. And we can see the power of this process. Yes, we lost on the first one. Okay, we lost a couple of $100 on that first one. We played the access. We recognized it wasn't the picture perfect access. Okay, notice the intuition. Right, I can recognize perfect access versus not perfect access simply because I've been looking at the access methodology for years. You will also notice as we went through part 3, I showed you the best ones. I showed you the really good looking ones, the textbook ones. I showed you the nuanced ones, and I showed you the failure ones. Okay, it's important to be able to recognize between the best and between the not so good. So now what we do is we go and debrief. Okay, end of the day's come. We switch off the trading system. Okay, we no longer need to trade. The trading system is now finished. Now we need to do the hard work. Now comes the debrief side of things. So the first thing we need to go and look at is we need to go and capture this tradable opportunity. Okay, so we go back onto our charts and we go and capture it. Now there's a number of ways to do it. I like to annotate. Okay, I love to annotate things. So I'll get a chart up and I'll go and write a text here. I'll go write consolidated triangle. Okay, because this is a consolidation triangle forming. Okay, I'll note that the positioning was neutral. Okay, and I'll note that dollar was bid all day and euro weaker minus 0.45% euro GBP. Okay, so straight away, what have I put on this chart? I haven't put wishy-washy stuff. I haven't put anything that's subjective. Okay, I've put the objective facts. I've stated we've got a consolidation triangle. The positioning was neutral. I've seen that on the daily chart. The dollar was bid all day. The euro was weaker, minus 0.5% euro pound. Okay, so these are objective facts. These are repeatable facts that I can observe next time and the following time and the following time. Okay, what else? What other objective facts can we extract out of this? Well, let's look at the execution side of things. Okay, we got one-time framing. Okay, that we can notice. We got one-time framing on this pattern play. What else do we notice? Okay, the access. Not ideal. Okay, so we notice we didn't have an ideal access on the breakdown, but the moment we got above that access point, right, we got a very nice entry point. So that's our access point. Remember, we use nice yellow lines. Okay, and once we got back above that, notice how the market retested the 138.20 perfectly. Okay, so perfect reversal access. Whoop. Okay, and this is all we're doing with our debrief. We first take our chart. We annotate it with everything objective that we can think about. So all those little things I was saying to you, the euro was leading. Okay, anything that's objective, that's repeatable. If we saw a really large order come in on the low here, like a 300-400 lot, and it got hit, then we point that out because that's an objective fact. So we update our chart with the objective facts. Okay, we then go and store it. So I like snipping tools. I showed you some of the tools earlier on in part 1. So we go and snip it. Okay. And what we do then is we add this to our catalog of tradable opportunities. So we go File, Save As. We go and save it in our file. Okay, so if we're creating a new file, assuming you're starting from today, let's create a file. And again, I wouldn't advise you ever keep anything on a desktop. Keep it on a Google Drive. So let's just assume, for example, that we had a Google Drive here. Okay, and our Google Drive, we have a new folder. Okay, we call this our trade strategies. Strategies. Okay, we've got this trade strategy called consolidated breakouts. Wait, a little bit slow today, this computer. Okay, consolidated breakouts. And we go and save it with the date and the market. So 08/03/2021 underscore or dash GBP USD. Okay, and bang, save. Okay, now we've captured this opportunity. Now the reason we do this is because you're only going to build your statistics. You're only going to build your observations. You're only going to build your pattern recognition through observing more and more and more of these observations. Okay. Now, how I would typically build a strategy. I would first come up with an idea. I would then go and back test that idea. In other words, I would go back in time and try and find the exact same opportunities, like I showed you with the filters. Okay, so I create a filter so that I can't, make up stuff as I'm looking for patterns. So I specifically create a filter that shows me exactly what I want to see so that I can observe those patterns objectively. Once I've objectively observed those patterns, I can also view the variables that make that pattern relevant. That was the filtering we did. Then we create the signaling. Okay, signal to me when these patterns are occurring. Signal to me when there's access. Okay, we can see a nice little access here. Right? That was the next step, was the access part. Right? And all of that information we eventually go and put on our cue cards. Okay, so we take our charts, we get all these opportunities, and now we go and apply them to the next time we have this potential trade opportunity. Okay, so we go to our cue cards, we go to our consolidation breakout, and we add to them. So for example, this tradable opportunity would have changed my SQN hit rate by, depending on how many sample size I've got, let's say to 0.45%. Okay. Now typically this process I would not do during the week, and I do not advise you to do this during the week. Don't tweak every single day. Capture the opportunities, make mental notes of them. At the end of the week, this is what you do at the end of the week. Okay, end of the week on a Friday or over the weekend, now you come and make the alterations to your cue cards. Why? If you're making alterations on a day-to-day basis, you're being a little bit, you're making too many adjustments. Okay, it's that sort of over-analysis paralysis approach. Right? You want to always keep this very, very simple. So we update. Okay, we update our process, we improve our process on a day-to-day basis. Now, it's very important from this point we go and debrief. Okay, so what we would do is we go now and we look at the analysis of our day, and we go and look at everything that's occurred on the day. Okay, so we can see that we had 2 trades today. We can see that that was our account balance. We made a nice 1.66% return on our account. We had 17.5 ticks, really nice day. We had a good win ratio, 1 loss, 1 winner. Okay, we can see what our maximum unrealized drawdown was. Okay, we can also see what our realized risk drawdown was. Okay, so you can see very clearly, what your statistics were saying. You can see we had 1 guardrail warning. We were a little bit underexposed. So there were a number of things that were going on, okay, that we can now go and observe in terms of the data. As mentioned, if you want to, you can view the charts, but now is not the time to do it. Okay, we do this only at the end of the week when the data will be meaningful to us. Okay, and that then is the process, guys. And we come in the next day, we do the same thing, we repeat the same tradable opportunities. We make sure that when we are trading, when we're putting risk on, we're focused on the objective facts. When we're outside and we've broken the continuous process, we're continuously building our strategies, improving our process. Okay, the better your processes, the more easily you're going to find it to be in the rhythm of the market and ultimately trade in the zone more often. That's now the end then of lesson 23. Go do the drills, go do the exercises, and we'll see you for the final blessing, lesson 24.